Hello. Today I'm speaking to George Cooke, Fund Manager of the Montanaro European Income Fund. The fund invests mainly in mid-caps and small-caps that are listed in Europe, with one of the key focuses looking for businesses with sustainable competitive advantages. The fund is top quartile in its sector over 3 and 5 years. What would you say are the main drivers behind that outperformance?
Yes. So I think firstly, we've got the small cap effect working in our favour. Historically, smaller companies have outperformed their larger counterparts, and that has been true in Europe over the last 3 and 5 years that you reference. We exclusively look at small and mid caps. Many of our competitors have a larger cap focus, and so that's provided a nice tailwind for us over the period. There's also quite good evidence to suggest that high quality companies outperform low quality companies over the long term. And our process just binds us exclusively to high quality companies. So again, that's something which has acted, I think, as a bit of a tailwind for us, and we expect it to act as a tailwind over the long term too. Beyond that though, we've got a really big team. We think it is the largest team out there looking exclusively at small and medium-sized companies in the listed space. And that's essential because there are thousands of companies out there in small cap land in Europe. They're under-researched and they tend to be, as a result, under-owned. And so we've got the resources to go out, find these hidden gems, and it's some of that sort of discovery process, finding things before others have had the chance, that I think has helped to drive returns at the stock specific level too.
Given, as you've just mentioned there, that smaller companies tend to, over the long term, outperform larger companies, given that's the case, why is it then that you think that investors on the whole tend to neglect investing in smaller companies?
Yes, it's a really good question, and you would think that that effect would have been arbitraged away, but when you look at the numbers, there's very little evidence to suggest that it has. I can give you a few guesses. I think, firstly, that the really big players can't really consider small cap in scale. Imagine if you were running a $100 billion pension fund. Well, if you put 10% of that pension fund into small cap, you'd have more in small cap than our company's entire assets under management. You'd very quickly run into liquidity issues, among other things. So if you've got those really big institutions, you know, they're quite limited in how low down the market cap spectrum they can operate. I think as well, it's very, very labor intensive. There are lots of small cap stocks out there that have no research written by the investment banks at all. And so you have to have a big team. There are thousands of stocks, so if you don't have a big team, you just can't cover them all. So there aren't that many people out there that have those big teams, and if you wanted to start one from scratch these days, it would cost you an awful lot of money and an awful lot of time. So I think that's possibly another reason for the inefficiency. I think, to give another reason, I think there's just a perception out there that small caps are inherently very risky. And while that's true for some small caps, when there are so many, of course, we would argue that there are some really high quality, durable businesses out there too. And so it's really a case of just finding those companies, and we think that can help to reduce that risk. I guess finally, there might just be a time horizon point coming here too, because small caps do tend to have bigger drawdowns when the market drops a lot. The small caps do tend to have bigger drawdowns than their larger counterparts, and so if you've got a short-term horizon, that might put you off. But as we've spoken about already, that's more than made up for over the longer term in all the other periods. And so for me as a long-term investor, I actually think that the risk, given their track record, the risk is that you don't own them and that you miss those exceptional long-term returns.
I wanted to now move on to portfolio activity. Has there been much portfolio activity of late, and could you run through your latest buys and sells?
Well, we are long-term investors, and as such, we try to keep our turnover as low as possible. So I'm afraid I can't talk you through the 50 buys and sells we've made in the last couple of weeks, because that is just not how we operate. We have sold a couple of stocks, and so we sold NOS, which is a Portuguese telecom operator. That was following a change in the regulatory stance, which we felt was going to increase the competitive threats and threaten their long-term returns as a result. More positively, Cerved, which was an Italian credit risk management services company, that was bought out earlier in the year, and so we were able to sell it on that bid. In terms of the purchases, we're always looking for new ideas. We're always trying to find some sort of hidden gems. And so a couple of the buys that we've made into the portfolio have been Shurgard. So they operate self-storage units. It's an industry we know relatively well. Shurgard, very good operators and one of the market leaders in Europe, providing a solid and growing dividend. And then we've got Kid, which is a Norwegian designer and retailer of soft furnishings, and they sell those through both stores and online. That's a company with a very good financial profile, but also a very attractive dividend yield with a dividend growth profile too.
And are there any sectors or themes that are of a particular focus at the moment?
Yes, well, we've got a really eclectic mix of companies in the portfolio. We don't actually want to have overexposure to one particular theme or one particular demand driver, and we really seek to actively avoid that to the extent that we can while keeping a quality and growth profile to the portfolio. Having said that, if we think about a couple of the sort of major talking points at the moment, I think one of them would be on some of the supply chain issues, and nowhere is this more apparent than in the electronics industry. Now that actually plays to the direct benefit of one of the largest companies we own. It's a company called NCAB. NCAB, they sit between printed circuit board and PCB manufacturers, who tend to be in China, and the consumers of those PCBs. These are companies in the West that need PCBs to make their products work, whether the product be a high-end scientific instrument all the way down to a lawnmower. They tend to all need PCBs. So what NCAB do, they sit in the middle here and they group the orders from all of their customers, and then they send them to their PCB suppliers, as I said, mostly in China, but they make sure that they are the number one customer of those PCB suppliers. And what that means is that they get priority. So when there are supply constraints, it's NCAB's customers that get the products first. And if you're not a customer of NCAB, you don't. NCAB are the largest player in this market, and because of this sort of advantage they have with scale, they are taking market share from their competitors, as well as enjoying the growing market as well. And in fact, it's been such a successful year for them, they very recently announced a special dividend. Perhaps one of the other themes out there is the ESG theme. And I think this applies both from a demand perspective and also an investor positioning perspective. So whether you agree with the environmental theme or not, I think you have to accept that green technologies are taking market share left, right and centre, whether that be combustion engines in cars changing to EVs, oil and gas being replaced by renewable energy sources, and so on and so forth. So we really sort of play this in two ways. Firstly, by avoiding the dirty parts, if you like, of the economic engine. So we don't invest in oil and gas exploration and production companies, for example. But more positively than that, we do try to own companies that are at the forefront of the energy efficient technologies or that help to enable them. So a couple of examples there be MTU Aero Engines. They make components that go into one of the most efficient aircraft engines in the world. Or Kitron, they're an electronic manufacturing services company involved, amongst other things, with battery management and electric vehicle charging units. So yes, there's for whatever theme there is, there are usually some interesting companies in the small cap world that you can use to get exposure to them.
And finally, do you have skin in the game?
I do, and in fact, everyone at Montanaro has skin in the game, from the CEO to the receptionist. A material part of our remuneration is invested in the funds that we manage, and as a fund manager, 3/4 of your allocation there, at a minimum, has to go into the funds that you manage. So we've got other incentive mechanisms too, but I think the key point to get across is that we've all got skin in the game. We all work together to make these funds perform as well as they possibly can. We're all incentivized to do that.
George, thank you for your time today.
Thank you.